Hello and welcome. Let's go across to that exclusive interaction with the management at Siemens. You rarely get to see them on TV, and when they chose to speak, they spoke to your channel. Let's hear out this exclusive interaction with none other than Sunil Mathur. Needs no introduction.
There has been a range of experiences during the lockdown time. The first wave was not as intense, and we were all at home, and it was a period of getting used to working from home. But then that extended into a short period where we thought this is behind us now, and things began to open up. We opened our factories, we opened our offices cautiously, but that was just for a short period of about 2 months' time, and then the second wave really came in. Now the second wave has been much more intense, as we all know. It did have an impact on operations initially, but that started somewhere towards the mid part of March and went in well into April and May as well. So I think we retreated back into the offices. Our factories, however, continued working. We had sporadic cases of COVID in them, but the management of the factories were able to juggle those capacities and manage that the health and safety of the employees came first, and in spite of that, keep the manufacturing activities running. So there has been really very little serious disruption to our manufacturing, and our employees have gotten used to working from home. So that really helped in keeping the business moving in the second quarter, January-March quarter. Starting April onwards, things got even more intense as far as COVID is concerned, and we became even more cautious. I think now switching to the business angle, we saw a real pent-up demand getting released from July onwards, and that went on until December. But we were surprised, very pleasantly surprised by the speed of the turnaround. And post-December, January to March quarters were also very good, with both private as well as government capex really kicking off. So that was really heartening, and we got a lot of interest in digital projects, a lot of interest in automation. Government spending started happening in the January to March quarter. The last quarter, April to where we are today, I'd like to say that the short supply products and our short supply items, the demand for them continues. There has been a slowdown in long-term projects, primarily infrastructure projects in our transmission, generation, distribution side. Primarily, these are government-related in the states, as the states battle with COVID on the one hand, but also dealing with the demand requirements. Some of the old capex has not really panned out, and therefore they're waiting for that to happen before they start ordering fresh. So things in the states and with government spending actually did slow down or has slowed down.
Okay. So many points there to sort of dive into in more detail, and we'll do that shortly. Also want to get a point of view from you on the export markets as well, and what you're seeing on that front. Are you seeing good traction? I mean, you have somewhat indicated that this quarter, but what's the outlook there?
Yes, Abha, I think the export market continued during the crisis, and actually, we were one of the few countries, probably the only countries, that had the lockdown, and our manufacturing operations were impacted in terms of the export. So there was a lot of concern there from international customers whether we would be able to meet our export commitments. I think the last few months have really helped, and the export demand, it continues there. We are hopeful about the increase in demand with the recent announcements of stimulus made by the United States and a couple of other countries as well. So we do believe this is the right time to focus on exports as well. Of course, we are urgently waiting for the RoTEP to be rolled out. That will give a major boost for exports, which at this time is really critical for the economy.
Okay. What about margins as well? Share with us the outlook on that front, and then we'll get into, of course, some of the more strategic lines that the company is taking. I mean, recently as well, we did see a sharp rise in raw material costs, but this was offset by strong realizations. Do you see that continuing?
Well, commodity prices have gone up. Transport costs have gone up substantially, and we're talking between 20 to 40%. So it's very difficult really to offset those kind of prices or cost increases with other cost-saving measures. Of course, the fact that there have been foreign exchange gains have to some extent helped offset that. But to a large extent, I think commodity prices are continuing to be high. I can't predict when they will come down, whether they will come down in the short term or not. But this is really an area of concern. And that is actually slowing down demand from our customers here as well, because many customers are waiting for commodity prices, transport costs to come down, because it impacts their business cases as well. So we are cautious about that really, and while we are cutting a lot of costs to try and offset some of these things, but you can't set off completely the huge increase there. The shortage of semiconductors has been a major increase as well, and in the impact here. And I think this is something that may go on for a longer period, and that was impacting both the demand side, with automotive companies being really hit as a result, and FMCG companies being hit as a result of that, and that really slows down the market as well. So I think there will be margin pressure in general in the next couple of months. We'll have to wait and see how long the commodity prices continue to be at the level at which they currently are.